Today, we're digging into a really high-stakes dilemma. It's about Nykaa, one of India's few profitable unicorns. This is a company that was built brick by brick on sound financial discipline by a former banker. But now it finds itself in a brutal street fight with competitors who seem to have a bottomless war chest. The real question is, can a smart, disciplined company survive a war against, well, infinite capital?
Nykaa started Nykaa at age 50, and she brought an investment banker's mindset to the startup world. I mean, while everyone else was just burning billions to grow at any cost, she was laser-focused on profitability, good governance, and building real brand trust in a market that was, frankly, flooded with fakes. That discipline got them to a huge IPO, but now that very same discipline is being pushed to its absolute limit.
And this slide really gets to the heart of it. You've got this fundamental clash of philosophies. On one side, there's Nykaa, built on profit and sustainable growth. And on the other, you've got these massive conglomerates, Reliance and Tira, who can literally afford to lose money forever just to grab market share. Think about it. They don't need to make money on lipstick. They can just subsidize the losses with profits from their oil or IT businesses. This is a battle of business models.
This quote just nails the new reality. Nykaa did the hard part. They proved that a massive market for trusted beauty products existed in India. And what was their reward for all that success? They attracted the attention of the biggest, most powerful players in the entire country. So the game isn't about creating a market anymore. It's about pure survival.
And that brings us right to our tipping point, January 2026. This is the moment where the whole market just fundamentally shifted. The Indian beauty space went from being a wide-open blue ocean to a red ocean, where there's blood in the water. And Nykaa's greatest strength, its financial discipline, could now actually become its biggest liability.
To really get a sense of the scale of this fight, just look at this number. That's over 3.3 trillion rupees. We're talking about $40 billion in annual revenue for just the retail arm of Reliance. This isn't just a competitor with deep pockets. This is a financial behemoth with basically infinite funding for its beauty venture, Tira. Now, compare that to Nykaa. Their gross merchandise value, that's the total value of everything sold on their platform, was just over 15,600 crore rupees. That's about $1.9 billion. Now, don't get me wrong, that is incredibly impressive for a specialized retailer. But when you put these two numbers side by side, you really understand the brutal asymmetry of capital. This is the core of their problem.
And here's the immediate impact, the first casualty of this war. A 29% jump in marketing costs year over year. This isn't just some budget increase. This is the price of going to battle. To defend its turf against the ad blitz from its rivals, Nykaa is being forced to spend more and more, and that directly squeezes the profitability that is core to its very identity.
And you've got to understand, this is a multi-front assault. Reliance didn't just launch Tira to copy Nykaa's model. They then locked down the exclusive deal with Sephora, cornering the premium market. They opened this massive, ridiculously fancy flagship store to reset the standard for luxury. And at the exact same time, you've got Tata coming in with tech, using AI for personalization. Nykaa is literally being surrounded.
So all of this brings Falguni Nayar and her team to a major strategic crossroads. There are basically three distinct paths they can take. But here's the catch. Every single one of them requires a major sacrifice. There's no easy answer, no magic bullet here. Just really, really hard trade-offs.
Okay, Path A, build a fortress of owned brands. This means doubling down on their own private labels, like K-Beauty and Dot & Key. The upside, it's huge. We're talking gross margins of over 60% and total exclusivity. Reliance can't sell K-Beauty, period. And the data shows this is already working. Their own brand sales are up 74%. But, and this is a big but, the con is massive. It creates huge conflict with their brand partners. If a company like L'Oreal thinks Nykaa is just pushing its own stuff, they could just leave and go to a rival. That would gut the platform.
All right, Path B is the B2B superstore pivot. The idea here is, instead of just fighting for the end customer, Nykaa starts supplying products to over 300,000 salons and local shops all over India. You're basically owning the plumbing of the industry. It moves the fight from flashy marketing to supply chain, which is a core strength for Nykaa. The problem? B2B is a low-margin, gritty business. That division is still losing money. And pivoting could really confuse investors who value Nykaa as a premium tech company, not some boring wholesale distributor.
And finally, there's Path C, the global escape. As the Indian market becomes a total war zone, they could just accelerate their expansion into the high-income Gulf region. And early results there look pretty good. The pro is obvious. Get revenue from somewhere else. But the con?
Well, it's a classic strategic mistake. You risk fighting a war on two fronts. Expanding overseas is incredibly expensive and distracting, right at the moment when they need every ounce of focus to defend their home turf.
So, we've laid out all the facts and the strategic options. But before we deliver the verdict, let's just pause. It's January 2026. You are in the CEO's chair. This decision, it's all on you.
First question for you. You have 500 crores of cash just sitting there. Do you A, burn it on discounts to match Tira's prices and just hold on to your market share, or do you B, invest that cash in R&D to launch new private brands and protect your margins? Are you fighting today's fire, or are you building a fireproof house for tomorrow?
And here's the second, maybe more subtle question. Can you actually have it both ways? Can Nykaa realistically stay a trusted, neutral platform for all these global brands, while at the same time becoming their biggest competitor with its own products? Or is this a strategy that just eventually destroys the very partner trust the business was built on?